No, so Brian is in Nebraska, Wood River, correct? Wood
Correct.
River, Nebraska. Owner of Bangs and Stewart CPAs, went to Nebraska Lincoln. And the biggest thing, Brian, is everybody is a business owner. They've got equipment, some have employees, some are looking to get employees soon. So the biggest thing we want to just discuss is what do we need to focus on for the rest of this month that we have to get done before December 31st. And then we can go into longer play of what else is out there to help capitalize on proper business growth.
Okay.
So I'll let you take it away.
All right, just one little touch on that. Yeah, so I own Bangs and Stewart CPAs in Wood River, UNL graduate in Lincoln, Nebraska. And then after college, I went to work for Deloitte & Touche, which is a large international accounting firm. Was there for a little while and then decided to go out on my own, moved back to Wood River, which is closer to home, and been there for 21 years. So I've been at it for quite a long time. We do a lot of small business, some ag, larger corporations and stuff. We got a lot of everything. So just jump right in. Probably the most important thing when it comes to owning a business, I think, well, first you have to make money. Second is once you make money, you need to figure out how not to pay income tax. So you can keep most of the money that you work hard to earn. Most of the planning can be done throughout the year, but the most important time again is at the end of the year, trying to jockey your way into being in the best tax bracket and paying the least amount of tax. So just to dive in, the most important thing I see, especially for younger people, is tax efficiency. And this may be a long-term thing, but we'll get into the short-term stuff. But tax efficiency is really important. And a lot of people don't pay attention to that. They pay attention to the dollar amount that they have to pay the IRS. But you really need to focus on the rate that you're paying. And not just the rate you're paying this year, but the rate you paid the prior year and the rate you're going to pay in the future. And maybe that's short-term and long-term. What a lot of young people do when they start making money, they don't want to pay any tax at all. So they spend their way out of income tax. And what I tell a ton of people, and I'm normally a guy that tries to get you out of tax, but you need to really look again at the tax efficiency and see what you're paying. And so what I tell everybody, on day one of planning is nobody ever went broke paying income tax. Okay. And then I follow that up with, when they're complaining about paying their taxes, I always say, I can't wait till someday I pay $1 million in income tax. And they think I'm crazy. They're like, why would you want to pay $1 million in income tax? Well, that means I got to keep the other 2 million, because I made $3 million. And so, if you're making money, you're going to have to pay tax one way or the other, or you're going to end up in prison. So, you just have to focus on paying the least amount of tax possible over time. And the people that really focus on that end up being more successful. And the people that really try to get out of income tax a lot, either they end up going broke or they end up paying twice the tax later on in the future. And so when I look at tax efficiency, you really have to look at the amount of income you're taking in and the rate you can squeeze it into. So, if you're in the 22% bracket, maybe you want to fill up the 12% bracket, which is the next one down. But you don't want to look at the bottom number and say, no way I'm paying $10,000 in tax. I'm just not paying it. That number should be really irrelevant to you. You should really look at the rate that you're paying. So the federal rates are, they're 10, 12, 22, 24, and so forth. When you're young, you definitely want to fill up those low tax brackets. Just out of history, in the last 50 years, the lowest tax brackets we've ever had have been 2018, 2019, 20, 21, and I'm not sure about 22. The government changes their mind all the time. I'm not here to pick on one political party or another, but during the Trump administration, they really lowered the corporate rates and the individual rates. And, if you go back 10 or 15 years, the middle class income tax bracket was 15%, and it stopped at 40,000 for married. Right now, the 12% bracket stops at 81,000. And so the brackets have really expanded. And so I don't think with the national debt and all the infrastructure bills, Build Back Better, all the trillions of dollars they're spending in stimulus, all of that money that they keep spending is going to have to be collected from the taxpayer. And so with all of that put together, rates in the future are probably going to go up, at some point. Maybe it's not next year. It's hard to raise taxes in the middle of a global pandemic, but eventually they're going to have to start going up. So if you want to pay taxes efficiently, don't be scared to pay, some taxes and fill up those brackets in 2021. So, emphasis again on tax efficiency, work with your accountant if you don't know what the rates are, and don't necessarily focus on getting out of the tax, but just filling up those low brackets at a minimum. Okay. So how do we do that?
Ryan, really quick,
Oh,
is
yeah.
that based on if you're paying yourself as an employee of the company or distributions, or is there a difference between those two for those brackets?
Yeah, those tax brackets are all the same unless you're in a C corporation. So there's a C corporation, which most people aren't, especially for small business. C corporations are, Coke, Pepsi, Intel, IBM, Apple, Amazon. They're all C corporations and they pay a double tax. So that rate now is a flat rate of 21%. And then you pay to get the money out to yourself, then you pay the other tax, which is tax on dividends. And so that's larger business. Small business is basically everything I said. It doesn't matter if you're an S corp or a sole proprietor. All those rates are taxed at the individual rate. So you don't really need to worry about whether it's distribution or salary or whatever. It's all going to be taxed at the same amount on the individual. So that's where your focus is at. Okay, so I skipped when you asked me that question. I lost my train of thought on the next topic. How do we get there? So if you're going to focus on tax efficiency, you need to figure out how to get where you want to be. So at the end of the year, there's a lot of strategies that you can use to get there. You're looking at two sides, reduce income or defer income or accelerate expenses. And so on the income side, depending on what industry you're in, but if you have year-end collections, a lot of my clients like to maybe not deposit that income on time at the end of the year. But what you really need to do is work with your customers, and especially if they're not, a business customer where they're looking for a write-off themselves, you can tell them, once you've figured out where you want to be, you can tell them, hey, just pay me January 1st. As long as doesn't create collection problems for you, deferring that income is an easy way to push income off to the next year. Now you have to deal with it. It's a timing issue, so you're going to deal with it next year, but at least you got your tax efficiency where you want it this year. So deferring income, just one quick mention on that. The IRS has a special rule called constructive receipt. And so that's pretty important to understand when you're trying to defer income. So if your customer hands you a check, December 20th, if you have it, then it's taxable to you. It doesn't really matter when you deposit it. So if it's in your hands or you're able to get to it, then it's included in that year. So you really need to be ahead of the game when you do the planning and tell your customers, hey, I want paid January 1st, January 2nd, somewhere in there. The other part of constructive receipt is called the Mailbox Rule. So if just because someone sent you a check and it's in your mailbox and you just choose not to get your mail, it's still technically income for that year. So the IRS is really going to go look at your deposit date. So a lot of people just deposit checks late, but just so you know, from an audit standpoint, it's really the Mailbox Rule. So if you have that income accessible or that checks, then it is income for you. So that's probably the biggest side on deferring income, is just delaying getting paid right at the end of the year. But I have a ton of clients that write me a check December 31st because they want to write it off. So, most of the time I tell them, all right, if you want the write-off, write the check December 31st for you, throw it in your mailbox, and it shows up in my mailbox January 2nd. So I can legally then take that income in the following year. They still get the deduction. So that's kind of some year-end timing on the income side. On the expense side, it's fairly wide open. The easiest one to do is prepaid expenses. You have to be careful. You can't overdo it on the prepaids, but for the most part, the IRS never calculates those prepaid limits. I think it's 50% of your expenses you can prepay. The biggest trap that people get into on prepaying expenses is buying inventory. A lot of, and I'm not sure on your individual businesses what you have, but if you're going to buy, if you're in the lawn care business and you're going to buy, fertilizer, and you're going to resell that fertilizer to a customer, you have to be careful that, prepaying $10,000 worth of fertilizer and you're going to turn around and sell that actually goes into inventory. So if you deal with cost of goods sold on your, your business books or whatever, buying inventory isn't a tax deduction. If it's something you're going to resell, it's just not a deduction until you sell that product, and then you take that as a cost. So, if unless you're a farmer or somebody like that, if you're growing sod, if you have a sod field, then you can prepay fertilizer. You can prepay your supplies. You can prepay interest at the bank, not prepay, but pay it up to date, before it's due. You can prepay your real estate taxes, stuff like that. So you just want to really, if you're trying to do your planning yourself, the best place to start is your expenses in your books or even on your tax return, and just take a look at the expenses and go line by line and say, can I prepay that? Can I pay that early? Maybe it's due January. Can you prepay it early? So any supplies, if you want to stock up on toilet paper and whatever for wherever you're at, for your business, then that's still eligible for all cash basis taxpayers, which is just about everybody until you get, larger. So cash basis, prepay all your expenses. Then the other thing that the people do is buy equipment. And so the equipment expensing laws right now are the best they've been in a long time. So you can buy the equipment and write it off all in the first year. So the expensing limits are, I should have looked at it beforehand. It's a million plus that you can write off in the first year for Section 179, which is the code section that allows that. But people don't pay a lot of attention to that. That's a dollar by dollar deduction. So if you buy a $10,000 piece of equipment, you can take $1 of it. You can take 5,000, whatever you want, dollar by dollar. So it's pretty flexible. On the flip side, there's the it's 168 bonus depreciation. And so that's 100% deduction, no limit on that. You can take 100% on new or used equipment. A few years back, it was just on new equipment. I think in 2018, they changed that to new or used. So right now that's available till 2024, I believe. Congress always extends that law every couple of years, so it's probably not going to run out. So that's another thing you can do. The biggest thing on buying equipment is it's when you're a cash basis taxpayer, it's not when you write the check. So a lot of people think, well, I'll just go buy a new pickup, so I don't have to pay income tax. Under the depreciation rules, you have to have it in your possession and it has to be placed into service. So that placed into service is the key thing what the IRS is looking for. So if you go to the dealership and say, yeah, I want this pickup, and they tell you, well, it's going to be, we can deliver it January 15th. And depending on how aggressive you want to be, but it needs to be on your property and using it by the end of the year. And there's a ton of court cases out there where the IRS has gone after people. Most of them are bigger ones. Somebody orders a plane and they have the plane, but the plane doesn't have the seats in it yet. And I think that was a court case and they didn't allow that deduction. So you have to be careful if you're going to buy a piece of equipment or a pickup or something like that, you have to have it in your possession by the end of the year and it has to be ready to be placed into service. That goes with all buildings and everything else that in those categories. So just be sure if you're going to do something here, especially with COVID and the shortage of chips, that there's enough time for you to get that in your possession. So that's pretty much on the equipment side. Buying equipment at the end of the year provides great flexibility. What I also tell a lot of people, again, nobody ever went broke paying income tax, and that's because you only should buy the equipment that you need. So, we do a lot of farmers, and a young farmer had come in, he was having a great year, and the price of commodities were extremely high. And he said, I think I'm going to buy a new tractor and a new planter just so I don't have to pay income tax. And that's what his goal was. And I said, only buy the stuff that you absolutely need, not to just get out of taxes. And he said, well, I need it. And I said, well, you really need it? And he goes, yes, I need it. I need it for next year. And I said, well, how did you farm this year? And he said, oh, well, maybe I don't need it. I just want it. So you just have to be careful. So especially the low tax rates right now, you're looking at, if you're in the 12% tax bracket, and our state is about 7%, so you're looking at 19% tax rate. And so if you're trying to get out of that tax, to go buy a $10,000 tractor or whatever you're buying, a pickup, you're only going to save that 19%. Well, guess where the other 81% comes from? It comes out of your pocket, that you're going to have to pay for. So you still get a nice pickup, but spending your way out of your tax with stuff you don't need is kind of a slippery slope to run down. It may work for a year or two, but you end up buying a bunch of stuff that you don't need just to get out of tax. And then you still have to pay the other, 81% or whatever tax bracket you're in. Maybe it's 75%, even 60%, to save 40%. You still have to be careful that you don't overspend